is Hillary Sunderland, and I'm the Chief Investment Officer of Beacon Wealth Consultants. Well, it's certainly been a nice start to the year for the stock market. Through the end of April, we've seen a tremendous rise in the markets year to date. So I just wanted to give you a brief market update, tell you what's going on in the economy so that you can stay informed as one of our valued clients. Well, there's been a lot of talk about when the next recession will occur over the last few months. So I wanted to take some time today to address how our economy is doing. The leading economic index is something that's published monthly and is used to predict the direction of the economy. It's comprised of 10 economic components whose changes tend to precede changes in the overall economy. And what this chart shows is the latest reading of the Conference Board's leading economic indicator index. So what you can notice here is those gray bars on the chart, those indicate recessionary periods. And you can see that the LEI, this index, tends to turn down prior to a recession occurring. And so currently, what you can see is that the LEI has flattened out a bit, but remains in expansionary territory, which is a good sign for our economy. Here's a chart of U.S. first quarter gross domestic product, which is a measure of the nation's overall economic activity, and it jumped to 3.2% for the first quarter, well ahead of market expectations of 2.3% growth. Remember that the definition of a recession is 2 consecutive quarters of negative GDP. So we are far from recession if you're looking at it from that perspective. The unemployment rate is currently at 3.8%, which you can see there from that yellow line, that is near a 50-year low. So overall, our economy appears to be on firm footing. We have some nice gross domestic product numbers coming in. The leading economic index is still in expansionary mode. We're at a 50-year low in unemployment. So where are we seeing maybe some troubling signs for the economy? Well, I want to take a minute or two to talk about inflation, because that's one of the reasons why the market has had a little bit of a sell-off over the last 2 days. So inflation occurs whenever the prices of goods and services increases over time. So if you have a basket of goods and it costs you $100 this year, and then the inflation is 3% year over year, the next year, the same basket of goods that cost you $100 this year will cost you $103 next year. And what that means is you end up losing your purchasing power over time. What you could buy for $100 now costs $103. So the Federal Reserve, which is the body of our government that sets interest rates for our economy, they have what's known as a dual mandate. So they try to keep unemployment low and inflation near 2%. And the reason for that is because over time, a high inflation rate will reduce your purchasing power and the ability to make longer-term economic and financial decisions. But on the other hand, a lower inflation rate, an inflation rate that's lower than 2% or even negative, well, that would be associated with either an elevated probability of falling into deflation or just outright deflation. And deflation occurs whenever prices are falling. Now, one might think that a general decrease in prices is a good thing because it gives you more purchasing power. And to some degree, that's true. But when inflation is persistent, it can have severe negative impacts on the economy. And during periods of deflation, what you can see from this chart here at the top is that people tend to save more money. And this really makes sense. Why would you spend money on something when it will be cheaper in a few weeks? If I am car shopping and I know that if I just wait a few weeks or a few months, the car I want to purchase will be cheaper, well, I'll hoard my money for a while and just wait to purchase it. So when you have periods of deflation, that's what's going on. The prices on average are decreasing. People tend to hoard more money, that they're not spending it as much, and because of that, economic production slows to accommodate that lower demand. Because economic production is slowing, companies reduce their workforce. They don't need as many workers if they're not producing as many goods. And then an increase in the unemployment rates eventually leads to consumers and businesses defaulting on debt. And the cycle can just continue and continue and continue. So deflation, or falling prices over time, is actually very bad for the economy. So the Federal Reserve, they use monetary policy, which that's a That's the economic term for interest rates adjustments to keep the economy running at about 2% inflation in order to reduce the likelihood of deflation occurring or runaway inflation occurring. And so where are we right now? Because this is what's causing a bit of a bump in the markets at this juncture. This is a busy chart, I know, but what you want to key in on there is the blue line. The blue is the core inflation. The latest reading is 1.55%. And the yellow line there, that's the Fed's target of 2%. So right now, where we are with inflation is that we're at a pace where it's not necessary for the Fed to hike interest rates to prevent runaway inflation because interest rates are low. They're below the yellow line. We're not really seeing a lot of inflationary pressures building up in the economy. But at the same juncture, they aren't low enough to cut interest rates either, which is what the Federal Reserve would do to stave off a deflationary period. And the cutting of interest rates was really priced in to the market over the last few months. If you recall from my previous market commentaries, I talked a lot about how the Federal Reserve kind of did a 180 on interest rates from the fourth quarter to the first quarter, from saying they were going to hike interest rates to not hiking, to saying they weren't going to hike interest rates. And the market took that even a step further, thinking that they would cut interest rates. And we've even had people such as President Trump recently talking about how the Fed needs to cut interest rates by another 1% is what he was proposing. So we had this expectation the Fed would cut rates, and what happened yesterday with the Fed's announcement was that, well, inflation is running at 1.55%, slightly below our target of 2%, but not low enough to necessitate a cut in rates. And so because the Fed said that they're pretty much going to stand pat with where they are on interest rates right now, the market took that as a negative because they were expecting something else to occur. And that's caused a bit of a pause in the equity markets for the last 2 days. It's only been 2 days. Hopefully this will just be the pause that refreshes. So that gives you a little bit of information on the economy. Overall, the economy domestically looks very good, and the probability of recession is still very low over the next 12 months, in our opinion. So now that you have had a brief lesson in economics, I'll give you a quick update on how the markets have performed through the end of April. This is a chart of the S&P 500 index, and the yellow line marks the previous highs established in September of 2018, right before the substantial drawdown that we experienced in the fourth quarter. In April, markets continued to perform well, with the S&P 500 index, a measure of the performance of large cap domestic stocks, so your biggest companies in our country, was up 4.05%. And finally, you can see right at the end of the month there, we finally broke through the previous highs established in September. Small cap stocks also had a decent month. Small cap stocks here, that's measured by the Russell 2000 index. They increased in the month of April as well, up 3.40%. But you can see, differently from the large cap stock chart I just showed you, we're still well below the highs established in September 2018. As of the last day of April, we're still about 8.2% below our previous highs. So while the S&P 500 index, which is what all the financial media programs typically focus on when you're looking at your nightly news and they're giving stats on what happened to the markets that day, they are usually quoting the S&P 500 or Dow Jones Industrial Average. But other parts of the market, which you also hold in your portfolios, have not been keeping pace with that part of the market. We're still well off the highs established for asset classes such as small cap stocks. So good news is they're still coming back. We had a good month of April for small cap stocks as well, but there's still quite a bit of room to run to get back up to where we were in the third quarter of 2018. So overall, where are we year to date? We're doing really well on an absolute basis. Domestic stocks, which are the yellow bars and the red bars there, are up over 18%. International stocks, the gray bars shown in this chart, are up 13.22% year to date. They are still lagging domestic stocks, largely due to a stronger dollar. One of the things you have to remember when investing internationally is while when you invest internationally, you're buying stocks in the local currency, so in the currency of the country where you're investing. And then in order to convert that back to US dollars, you have to do a currency exchange back to US dollars. It's called currency translation. And so because the dollar has been going up versus foreign currencies, when you translate those returns back into US dollars, you end up losing a bit of your return. And so that's one of the reasons why international stocks have been underperforming domestic year to date, is because of that very strong dollar that we've seen. Bond markets, the blue bar there is measured by the Barclays Aggregate Bond Index, are up almost 3% year to date. And then finally, commodities also up year to date, 5.88%. So on an absolute basis, we've had a really nice start to the year, have a little bit of a way to go before we get back to those all-time highs in several asset classes, but we are getting there. The economy looks healthy, and performance year to date on the LightPoint portfolios has been very good. The majority of our models are outperforming their blended benchmarks year to date. So we thank you for your continued confidence. We will continue to watch the economy and the markets and make adjustments as warranted to our portfolios. But in the meantime, please reach out to us with any questions you may have.